Now, markets have been all over the place recently, haven't they? And with everything that's going on in the world right now, it doesn't look like we're going to get much respite anytime soon. So, it goes without saying that a lot of us are wondering what on earth we can do to keep our investments on an even keel. Should we change what we're doing? Should we stop investing? If we're new to investing, should we stay away? In short, what's the best course of action at times like this? Hello, I'm Brian, and in today's video with MoneyFarm, I'm looking at investing in volatile markets and some of the strategies for coping when everything gets a bit challenging for investors. Let's start with a quick look at volatility and what it means in the world of investing. Well, all investments can rise and fall in value, and volatility is a way of describing how much and how quickly values move up and down. When markets are volatile, they can rise and fall dramatically in a short space of time, which is why you so often get those images of hair-raising roller coasters when volatility comes up, and understandably so, because it's not just the peaks and dips on a chart that resemble a roller coaster. Experiencing the value of your investments going up and down in quick succession can give you that stomach-churning white-knuckle feeling too. On the flip side of all this, when markets are less volatile, investment values don't jump about so much. Also, some investments are more prone to volatility than others. For example, shares are typically considered more volatile than bonds, so you don't tend to get all investments behaving in exactly the same way at the same time. So what causes volatility? Well, it's a whole host of different things. Political change, like the election of a new president or party, wars, unexpected events, for example, a natural disaster, pandemic or terrorist attack, or economic events, like a recession, changes in interest rates, and inflation. Now, these kinds of events matter to markets because they create uncertainty about the future, about company profits, trade, economic growth, or the stability of entire industries. And markets hate uncertainty. When investors can't predict what comes next, they tend to reassess what things are worth, and that reassessment happens fast. But it's not just about the events, it's how investors react to them. When uncertainty rises and confidence falls, you often see a surge in selling, which pushes prices down. Then on the back of more positive news, buying can pick up again, lifting prices. All of this can happen incredibly quickly. So for the average person, by the time something even hits the headlines, markets have already reacted, which is why it's so tricky to know what to do during volatile times. And we've seen a lot of these recently, haven't we? In fact, it can sometimes feel like the world just lurches from one bout of extreme volatility to another. But on the positive side, look back a few years or even decades. You'll see that volatility is nothing new. Markets have taken hits before, falling by 20, 30 or even 50%. It was probably alarming for investors at the time, but then markets overcame the chaos and went on to recover and grow. Sometimes this happened quickly, sometimes it took a bit longer. During COVID in 2020, for example, the S&P 500 lost 34% in just over a month, but then it rebounded rapidly, rallying more than 70% over the next year. Things took longer when the dot-com bubble burst in 2000, with the S&P 500 falling almost 50% over 2 years or so, and the Nasdaq plunging even more. The recovery took longer, but it happened. I could also cite Black Monday in the 1980s, Wall Street in the 1920s, Trump's tariffs in 2025, and so on. Of course, just because something's always happened in the past doesn't mean it's guaranteed to in the future, but history does help us put all this into context. Okay, so what can you actually do about volatility? Well, the first thing to say is that as an investor, you can't avoid it altogether. And it's not a bad thing that you're trying to eliminate, because investing and volatility go hand in hand. It's the price we pay for potential returns. But that said, we can take steps to manage volatility. But before I explore how to go about doing that, let's have a look at common mistakes investors often make. Number 1, panic selling. When markets fall, getting out might feel like a safe thing to do, but selling during a dip locks in your losses at the worst possible moment, whereas staying invested gives your money the chance to recover alongside the market. Recovery isn't guaranteed, but as my previous historical examples have illustrated, markets have bounced back. Number 2, timing the market. It can be tempting to try to time things so you sell before it all goes pear-shaped and then wait for the right moment to get back in. But when is the right moment to sell or buy back in? Well, with hindsight, these points are easy to spot, but at the time, they're almost impossible because often the strongest market days happen very close to the worst, and at times when headlines would suggest that recovery is a long way off. An excellent example is when markets rebounded during COVID. Things were still very gloomy and extremely uncertain, so countless investors got caught out. They were on the sidelines, feeling comfortable that they distracted themselves from a hairy situation. Number 3, pause in your investment contributions. Committing more money to markets when they're volatile can seem counterintuitive. Why invest when prices are falling? But this is actually where regular investing works in your favor through something called pound cost averaging. When prices are lower, your regular contribution simply buys more units than it would at a higher price. And over time, this can reduce your average cost per unit, meaning you need prices to recover less than you might think to start seeing gains. It's one of the quiet advantages of staying consistent through volatile periods rather than stepping back. Number 4, changing your strategy based on headlines. Changing how you invest because of what's going on in the short term is a surefire way to derail long-term progress. When you react to headlines, you often end up buying high, selling low, or choosing investments fit with your goals, time frame, or risk level. And you could end up with too much of one type of investment, sector, or region, which would affect the balance of your portfolio. Okay, so those are some common mistakes. But what tends to work well when markets get rocky? Here are a few principles that many investors find helpful. First, diversification is key. By spreading your investments across different assets, sectors, and regions, you can help smooth out the ups and downs. That's because markets don't all move in sync. When one area is struggling, others might be holding up better, helping to balance things out. Also, a diversified portfolio that's aligned to an investor's goals, time horizon, and risk appetite tends to be better placed to sustain volatility. Second, invest regularly rather than reactively. Now, I've touched on this already, but regular investing, for example through a monthly direct debit, means you'll benefit from pound cost averaging, which means that when prices are lower, your money buys more, and when they're higher, you get less. Many investors find it psychologically easier to keep investing if it's happening automatically, because you don't have to commit more money to markets when they're yo-yoing. Third, focus on the long term. Investing isn't for the short term, so keep your eye on the horizon and your future goals. Markets might be volatile right now, but they do have a history of recovering, and over the long term, today's ups and downs can seem far less daunting. When you get caught up in the short-term noise, it's possible to end up doing more harm than good. Fourth, consider delegating investment decisions. For those who prefer not to navigate volatile markets alone, one way to take the emotion out of investing is to get a professional to do it for you. Now, you don't have to be wealthy to do this because there are plenty of ready-made investment portfolios such as the one that MoneyFarm offers. Basically, you'll get a globally diversified mix of investments matched to your goals and risk profile, and this is managed by an expert. Of course, this won't eliminate volatility, but at least you don't need to get involved in all decisions at all moments because you have a professional doing that for you. And finally, keep cash for short-term needs. When markets are choppy, you don't want to be forced to sell because you need the money. Having some cash savings gives you breathing room, and this can make volatility a little easier to handle. So to sum up, yes, volatility is uncomfortable for investors, and there's no getting away from that. But with a few tips and best practices, you can work with it and build your investment portfolio over time without getting sidetracked. So there you have it, your quick guide to investing in volatile markets. If you found this helpful, please subscribe and check the description below for more on MoneyFarm and how to start investing today. And as always, I look forward to seeing you in the next video. Bye bye for now.